All right, so this video here is geared more toward my friends who are interested in investing in real estate, specifically single family properties or small multifamily, so 1 to 4 units. And basically, my question to you is whether you already invest or whether you're looking to invest, whether you are interested in more of a cash flow property or the appreciation type property. Obviously, you would want, to maximize both if possible, but typically those two types of investment strategies are on opposite ends of the spectrum, meaning if you want a home to appreciate, homes that go up in value the most typically aren't always going to be the best cash flow properties. So thinking more specifically toward like your coastal cities. So say a property out in California or any really highly desirable area, those are typically going to increase in home value the most over time, but it might not be feasible. You might actually have to pay every month, even with having a renter there, to pay down towards your mortgage. So that's where it could be a little tough to get started, especially if you are younger or you don't necessarily have a huge bankroll right away. So it's a slower start for sure. Whereas the cash flow investor, you can buy, if you really wanted to maximize cash flow, you could buy properties in rougher neighborhoods or less desirable neighborhoods and charge a pretty premium rent, at least compared to the purchase price. So for example, a lot of cash flow investors, they go off of whether you call it the 1% rule or the 2% rule. 1% rule is just saying that if you buy a property for $100,000, you would rent that out for $1,000 a month. The 2% rule would be, say you're still getting that $1,000 a month, you would actually buy that property at $50,000 for your purchase price. So essentially, it's your monthly rental income should be 1 or 2% of your purchase price. So with that, you're almost guaranteed, unless your property taxes are ridiculous or you are in a flood zone, so your flood insurance is going to be too high. But you're almost guaranteed to be cash flow positive, meaning you're putting extra money in your pocket every month there. And basically, that's when all of your income, so your gross monthly rental income, covers all of your expenses, which would be your principal, your interest, taxes, and insurance. And then not only that, but in theory, to get your pure cash flow, you should be also calculating and kind of budgeting for a property manager if you choose to use one, vacancy rates, repairs and maintenance for the little upkeep things, and then also capital expenditure for your big ticket items like your roof, furnace, air conditioner, etc. So the pro of being a cash flow investor is it seems like you're making a lot of progress quickly. You're able to take action quicker because most of the time those properties are going to be lower priced, and then you're able to see the progress by seeing your bank account rise in value every month when you're making your deposits. But where I think that might actually be a little short-sighted is just based on the appreciation as well. So yes, you'll be making money from the get-go, but who's to say that property only increases in value? Maybe it doesn't even keep up with inflation, or worst case scenario, maybe it actually decreases in value, because we've seen that before in especially rough neighborhoods where there's just so much blight, and the city has to condemn certain properties, or they want certain properties torn down. That is not a desirable area, and a lot of the times people who can leave do leave. So you end up having a decreasing population rate, and with that you still have the same supply of houses minus the ones that have been torn down. So you still have the same supply of houses, but the demand is decreasing because you have way less people that are in need of a house. So you can't even increase the rent rate that much. Otherwise, you're not going to be competitive, and people will leave for less expensive houses then. So not only are you not getting the home value increase, but you're not really doing much extra with the rental income. So if you're only making, say, $100 net per door, or $200 per door, let's use $100 to make it easy. If it's a single family home, you're only making $1,200 for the year, and that's it. Whereas if you buy based off of appreciation, even if it is a $100,000 property, which you're not going to find anything in our area that's, say, like an A area or B area neighborhood for $100,000. But just to use the example to keep it simple, last year in our area, home prices increased about 14% year over year. So that $100,000 property is now worth $114,000 if you went to go sell it on the open market. So, you're making, or you're adding a lot more equity and you're building wealth much quicker by buying for appreciation, assuming that the market still stays the way that it does, which it doesn't always. But a lot of the times people don't feel it just because you don't see that money in your bank account. So you only realize that money when you either refinance or when you sell. And again, over the short term, there's definitely no guarantee that that home prices will be going up, especially with how hot the market has been. But over the long term, real estate almost always goes up if you're buying in a good neighborhood. So those are kind of my thoughts on real estate investing. I'm kind of somewhere in between, so I definitely don't shoot for the 2% rule. 1% is great. Sometimes it's okay to be slightly less and you could still make money. But I'm just not at that point in my investing career where I'm buying, $300,000, $400,000, $500,000 houses either. So yeah, that's kind of my thoughts on it. If you guys want to comment below, I would love to hear your thoughts, just to see kind of what line of thinking you're thinking, which way you would lean towards investing. And if you do have any questions, let me know, whether you're commenting below or just sending me a direct message as well. And I hope to hear from you guys soon. Thanks.